Hey there, Michael
Hey,
Hopkins. Hey, how's it going? Michael
good.
Hopkins, Alpha, here with Jennifer Warren from Concept Elemental. Hope things are going well for you.
Well enough. Yeah, we just had some tornadoes last night and here in Dallas, and now today it's a beautiful, sunny, cool day. The wacky spring weather is here.
I did see some of that.
Yeah,
It's that time of year.
yeah.
So again, we're having this discussion around the energy world, what services, and again, you shared some of these materials with me prior to the conversation we're having today. And again, what's surfacing is geopolitics, but even more importantly, probably the big theme that's been with our conversations before, and that's the energy transition. And with that, with the transition dynamics, we've got this outlook from BP that you'd like to share with us. You have slides from BP's, sorry, not GP, but BP's chief economist. If you want to run through those slides, there's a significant geopolitical element to this, along with the impact from US policy. But I also see that theme again, energy transition, and some of the conversation around that. So you want to dive in, take a look at the first set of slides?
Sure. So just to set things up a little bit, BP in early February, sort of came out and said that, we're revising kind of our outlook. They're going to not, slow their hydrocarbon plans as much as they intended, meaning producing less hydrocarbons faster. They were kind of one of the green first movers in a way in terms of oil majors. Now, calling themselves an integrated energy company, that's their direction, and it has to do with the transition. So there was a presentation by their senior economist that, and really his focus was the impact of the war of Russia's invasion of Ukraine, how that's changed the energy outlook. And also he focused exclusively on the war and the IRA, the Inflation Reduction Act legislation, our green policy, if you will. And we've discussed this in the last several videos. We went through this actually in the last, I think, 4 that we've done, 4 or 5. And so this is kind of an evolution. But what's really interesting is it's some numbers and some trends, according to BP. And then I'm kind of syncing it up with, sort of what I see from this point of view. And one thing that underpins some of this is that, they're modeling this impact based on that there's a commodity price shock because of Russia's invasion. And they actually ascribe a 30% premium to imported energy per region because of this. And in Europe, the security premium is 60%, meaning costs are going to increase because of this, basically. And we've seen that in Europe, especially. And then energy security is weighing in more. And then also that there's a reduced pace of globalization. And we talked about this last time on the Brookfield slides, deglobalization, nearshoring. We've been talking about this throughout, even with the Europe's, solving Europe's energy crisis. The first video we did, we talked about these trends. But I will just jump into the slides, and then we can, if you have a question or something, we can, pause it. But so you got these okay? Let me get this off. So this first slide is about, this first slide is about their outlook and sort of what they see as trends, major trends. I don't know why this is doing this. Let me just try to put it on full screen. That might help. Uh-oh. Oh,
There
wait.
you go.
Oh, wait. Let's go back to that. I just messed up. Because you popped out and then you popped up. Okay. Okay, so 4 trends. Their view is, this is BP's view, that there's a declining role for hydrocarbons, that there's going to be a rapid expansion in renewables, increasing electrification, and this is here on the bottom, the electrification, and then low carbon hydrogen. They expect there's going to be increased use of low carbon hydrogen. So their worldview is one that some ascribe to, but I would say there's a lot of majors that do not nail it down this hard. So that's one thing to note. And this is important because, investors are making decisions based off of scenarios and placing bets and, where's the puck going? How are things changing? And so this is a very specific outlook of BP's. And as you can see, they, what's relevant here is this to me. So the green line represents what they call new momentum, which is if things just cruise along as they are, the impact of the war and the impact of the decarbonization that we have on the books, this is how fossil fuel usage as a share of primary energy declines. This blue line is net zero, and that's getting to minus 1.5 degrees Celsius. The middle line, the yellow, is getting to minus 2 degrees Celsius, an accelerated transition. Net zero is obviously a, harder, faster transition, and so that's kind of just so you can know that going into this. And then obviously they see, even in new momentum, they see quite a rise in renewables because they feel that with these energy security concerns that there's going to be more local sourcing of energy, and that can include renewables, hydropower, nuclear, and then there will be importing, natural gas, especially in Europe. And then we've seen this slide before, and I'm pushing this one back because it's, putting it back out because it's, kind of instructive. It shows very clearly, this is what they see as the change in 2035. Nearly 6% increase in renewables, 6% decrease in natural gas, 5+ with oil. And then, this is all on the right-hand side, just the reduction in carbon intensity. And nuclear grows some, but they think modestly. And so next, this is how it plays out in 3 large blocks that are big natural gas importers and oil importers. So they say, let me get to my notes too. Let me see if I have anything. No. They believe that, so this new momentum, again, is the fact that the wars happen and the fact that we're still on this decarbonization drive. So the solid green line is their new outlook. The line that's lighter and dotted is what they were projecting before in 2022. And that is because this was, before Russia happened. So it's interesting because this is the world according to BP before Russia happened, here and here. This is the world according to BP after the invasion, how the invasion of Ukraine has changed the energy map. And they're saying that there is a general reduction. This is the EU here on the left, a pretty steep reduction in the use of oil and gas. This is to 2050, going from like 50% primary share of energy down to 25. That's a dramatic shift. And I don't know that that's really correct. And then here we have China, increasing. Here's 2020, increasing in new momentum, and but increasing less. And that's all because of the GDP hit that everybody takes because of the invasion. And India, the same story. Now, what's interesting about India is India here, actually their share rises, oil and gas imports, because they're going to be growing faster in a consistent way. I mean, that's the expectation. And I think that's right. I mean, I think there's a lot of action where India is. And by the way, India holds the presidency of the G20 this year. And so I think there's more focus a little bit on India. Not that BP was, syncing that up, but I just want to make a note of that. So that means that, they're going to be spotlighting global issues. And I may have a role in some of that with some of the civil society organizations, but to be determined yet. And so now this is how this starts translating. This is where the rubber meets the road on these projections. So this is how Russia's production of oil and gas is revised downward because of the war. So here in 2022, it started in February. Okay, so, and this is, their 2022 view versus their, 23 outlook. And this is their new momentum case. Again, the war happened and we're on this decarbonization drive, energy security concerns, oil price shock. Here's how it looks. And so just over 1 million barrels a day were shaved by Russia at their production. Now in 2030, it goes to almost 1.5, 2035, same, 2040, so basically what they're modeling is that as a result of this, Russia will be reducing their production over time. And actually the whole numbers it translates into is, let's see, in 2019, they were producing 12 million barrels a day. And then the projection according to BP is that in 2035, it's going to be between 7 to 9. That's a significant drop. Now, the opposite side of that trade, which is interesting, is that US shale from 2010 to 2019, in 2010, we produced 2 million barrels. Shale happened. Now we're producing 12. We went in 1 decade from 2 million barrels a day to 12 million barrels a day. That's a 10 million barrel increase over a decade. Now they're saying in 12 years, it's, anywhere from a 5 to 3 million barrel reduction in production. That's a lot of economic activity. And then over here on the gas side, they're just showing how it changed. This is the LNG trade that's expected in 2030. And again, the revised outlook because of the war and decarbonization. And so this over here on the right is just their drill down about the LNG trade. But what's significant on this gas demand, this purple bar, which is pipeline trade, this is Russia's pipeline trade. Virtually and this is, crazy. A whole 150 BCFs were just taken away, weren't happening, largely going to Europe. So that's interesting. And then this is the blowout of the exports in 2030. So this pipeline trade gets knocked out. It's not happening to Europe. Now it may go elsewhere, may go to China and India. I don't know. But this is all the LNG trade. And what's interesting about this, so their assumption of this reduction, they're saying there's going to be a big reduction in, in gas, because we just saw that where they said, it's going to be like 6% less or something. And that is because they say it's because of reduced GDP and the reduced preference for importing gas, meaning Europe's not going to want to import as much gas. Therefore, they're going to produce more renewables, that local sourcing kind of thing again. And then the other thing that happens with this LNG trade, see this upper purple here, LNG exports, that's what the United States picks up largely in 2030 because of Russia being, Europe not using Russia's pipeline imports. There's more US LNG going to Europe and elsewhere. So the US picks up half of the LNG trade that would have existed. That's anywhere from 12 billion cubic meters to 20 billion cubic meters, for anybody that's paying attention to those kinds of numbers. And so this is about Europe's need for LNG imports, and also its success on reducing natural gas demand. And what's kind of interesting to me about that is if we look at this, okay, accelerated here on the left, this is the gas that they would import in an accelerated case. Now over here on the new momentum, let's look at the new momentum, because that's kind of more, okay, this is reality, according to BP, this is what's likely, this is what's happening unless we do this big acceleration in, carbon reduction. And so this domestic production is minimal there, in Europe. It's not that much. And then you have all this LNG imports here in 23 here on the far right. And as we know, the US is going to be a big beneficiary of that. But here's where I kind of diverge is, on this domestic, production, and we can, maybe address that in your questions. But basically, BP believes this gas demand reduction happens because of going to low carbon energy sources like renewables. But there's other ways to skin that cat. So now this is just talking about the mix. So the changing mix of global oil supplies are dominated by US shale, tight oil, and OPEC production. And what's really kind of interesting here to me is over here on the right, this is OPEC's market share. Right around probably 2015, it was, just under 40, it went up, and then it went down to like 35%. Well, that share, a lot of that share was lost to US production, basically. And it looks like in this new momentum case, which is the, sort of like business as usual, just we're trucking along, this green line here, this is how it changes, and they start picking up market share after 2030. Now, a lot of this share that they're not taking, it's because the US is taking it. And this is US tight oil over here on the left. It's the green. And let's look at new momentum. So they're saying that from now to 2030, the US is going to pick up, 500,000 barrels a day, the annual change. And that's up to 2030. But then they project, BP projects after 2030 that US shale will reduce about 500,000 barrels a day. And as does the rest of OPEC. So that's why they model OPEC taking more share later. Now, that's hard to say, I know Scott, we talked about this last time or the time before, or both times, about Scott Sheffield's analysis of the Permian and US production, that there was a peaking in 2030, and then it's a plateau. So, there's a lot of devilish details to this, these outlooks, and so as an investor, the energy transition makes it harder to just, buy a stock and hold it for 2 decades, specifically energy related stocks, that's one of my takeaways. And then LNG exports dominated by the US and the Middle East. And we've talked about this before, that, the US has been we talked about this, last year at the end of the year, that the US is and natural gas is a big beneficiary because of the Russia invasion of Ukraine. And as we see here, looking at this new momentum in 2030, the green here is US natural gas. And then in 2050, again, in the new momentum case, US natural gas, quite a bit of growth there. Over here on the right, Russia LNG exports in 2050. They're on the far right, this bar here of their 2023 outlook. So they see by 2050, there's some, growth in Russia LNG exports. I'm trying to think if there was anything else relative to that. One thing too that BP expects, back to just thinking about that oil slide, I don't know where it was, is that they're saying that the US peaks at 11 to 16 million barrels a day of production. And that's a big range, that's a big variance. And I talked about, OPEC picking up share, the LNG. The other thing to note about this, just that I wanted to say about LNG exports is, we know that all these, we've talked about this before too, just all the facilities that are being built in the United States, the LNG export facilities. There's also, I just saw a lot of pipelines being built that are within state, not between states, meaning they're not building these pipelines to take gas from the Marcellus to the Gulf Coast. They're building them within the South, Louisiana, and Texas, where there is less pushback about pipelines, which is a bit of a problem for the Marcellus and Appalachia. And, that could change in the future, just based on need and opportunity. And political administrations, viewpoints. And this is, I just put this up because this is actually from a Seeking Alpha piece. And this is, I think, Ron Patterson. The green is Russia here, and this is 2021, and it goes to 25 here. And as you can see, this is oil. As you can see, it's like peaks at roughly, just over 10 million barrels a day. And then it goes down here in 23 to, 9 million, and then it kind of plateaus. He's got a bit of a different, this is short term, but look at the yellow here. This is the US. So what's interesting to me is what is taken from Russia is given to the United States. There's just like this opposite trade. It's kind of, I thought that was an interesting thing. And then this is just a slide that we talked about in Solving Europe's Energy Crisis. It's showing a timeline of how long it takes. Okay, in 2003, Europe, including the UK, was almost 60% self-sufficient. They were producing their own resources. It goes down to 20% because they start importing Russian gas. And we know this line is, their dependency line. So that took 17 years, to change that. And then we have this reverse trend, right? They're trying to either become more self-sufficient. BP would say they're going to do it with renewables and a little bit of nuclear, and they're going to use less gas. Well, how are they going to electrify? And they can't fully depend on renewables. That's just not going to happen for lots of reasons. And this is sort of the energy. This is just a slide that's representative of the energy transition. The demand for the critical minerals that we've talked about before. I think we did almost a whole video on, all this IRA legislation, the Fed analysis of minerals. So just looking at new momentum here in copper, from where we were in 2020 to there, that's like double. That's 2 times. Lithium, new momentum, from very little to 3 times. Net zero, 6 times. You need 6 times the amount of lithium. Nickel, same kind of trend. And there is a base demand already with that. And this is all driven by electrification of transport, EVs. And then over here, copper, it's, low carbon power. I'm trying to see if there's anything. So, and it's all path dependent. These projections are all based on, okay, what path do we actually really take? How does this play out? That sort of thing. And I would just point back to, something that they mention, let me see if there's one more on this. Okay, here we go. Something that they mentioned, BP, is that, and this is not modeled in what we just saw here even, is that there's still, okay, this is just investing in pure renewables here, wind and solar right here, from 400 billion in just the recent era. And then new momentum, the green, it actually goes down, it goes up if you're doing the 2-degree scenario. And then in the new momentum over here with wind and solar, it's not even where it was, So I don't know how you square all that. I don't know how the math works out on that. And then this is upstream. Interesting that we were spending the same amount, 400 billion a year. And then they expect that to be the same roughly up to 2030. This green in new momentum. Again, business as usual, as things are playing out, as GDP is being hammered a bit, as inflation's taking hold, as decarbonization is happening, and then in new momentum, you still have a similar amount of oil and gas investment. And then the other thing that is missing from these investment dollars, and it's an obstacle, is transmission, the money needed for transmission, the change of electricity markets to accommodate more renewables, and dealing with the issues of intermittency with renewables. And I discussed this in my Texas $1 Million Mile article, because Texas is a poster child of this. And I've started digging into that and looking at that. And there's been a lot of stories since I wrote that in the Wall Street Journal and The Economist, talking about the grid finally, realizing that, with renewables, there's a grid issue here. And so that has to be factored in. And from just what I worked on, $1 million a mile for just transmission, and that's on the cheap side. It's more like 2 million. It can be $5 million a mile, and the ratepayers pay for that. So I will stop sharing. And
So
yeah,
looking all that, we keep going back to the BP slides, to some of those slides, and like you said earlier, especially when it came to the oil production here in the States, or for the shale production, the big variables in there, or even like more generally the economic factors that can be tied into some of these forecasts. Maybe you can expand a little bit on the headwinds in the outlook from BP. Are there things that maybe they didn't consider or think about?
yeah. Well, I think one big thing that was not considered is the potential for Europe to produce their own gas resources. And we talk about that in solving Europe's energy crisis. And I know that Spain is producing more of their resources. They're starting to do that. The UK was going to. They had lifted a moratorium on large-scale hydraulic fracking. And then once the Truss government went away, and this new government came on board, they sort of, reversed all that, put the moratorium back up, and they have huge shale resources that would rival the Marcellus. They could almost be self-sufficient in natural gas, if they produce their own resources. But they're, very much kind of still in that real green push idea. But you have a lot of energy cost rises resulting from it. And then Germany has a lot of its own resources. Now, Germany, we know, they're building a bunch of LNG facilities to import more. But I think over time you could see that shift. There's a lot of gas there, and in the regions nearby, and which is not Russia. So I think you're going to see, perhaps by necessity and practicality, the start of producing more of their own resources. And actually, the irony is, just from the numbers I've seen, producing your own resources actually has less of a carbon footprint than importing and then pipeline gas from Russia. So that's the irony of it all. Yeah. So that would be one thing that would be missing. I'm trying to think. Oh, how much they think electrification will happen. Now, I'm kind of like, I don't really have a fixed view on there's going to be a lot more electrification and we're going to have a lot more EVs and we're going to, all that. Now, I think if there's going to be more electrification, there's got to be more density on the grid. And as we know, we've discussed this, that nuclear is the most dense. There are other, ways to skin that cat. And I think, I had a discussion actually yesterday with a really sophisticated global natural gas producer. And there are all sorts of low carbon technologies that are coming online to make natural gas cleaner, more efficient. So I think what you're seeing with this IRA legislation that BP focuses on, that I didn't really mention, but because we've mentioned it so much before, but it is part of this mix, is that with the new credits and subsidies for CCS, carbon capture and storage, I think you're going to see just more progress towards reducing the carbon intensity of oil. That's already happening. We know that. Reducing the carbon emissions in oil and gas production. I just worked on some research where there was out of 69 top oil and gas firms, I can't remember the exact number, I don't have it in front of me, but there was a lot that pledged, to reduce carbon emissions with concrete paths to get there. Some saying they're going to be net zero, and so they're going to do things to make that happen. They're going to use technology. They're going to figure out they will be using renewables in their production, the grid, to reduce using diesel, to run rigs and things like that. So there's just a lot of ways that I think that the oil and gas industry will in fact be, trying to find ways to do it better. And I think too, I know there's just this big push with EVs, and the other thing BP assumed was that there's going to be all these battery electric cars, battery EVs, plug-in EVs. And I think, hybrids make a lot of sense, just given the legacy systems that we have. And I know a lot of these oil and gas companies like Chevron and Exxon, they're trying to find ways to do more sustainable fuels, so there could be things that we're not really considering, other technology breakthroughs that are not wind and solar. Sure, wind and solar, they're going to figure out how to do it better, be more efficient, but money costs. And so I think there's just going to be there should be some serious thoughtfulness about how you invest, where you invest as a large oil and gas producer. And then for us as investors, looking at who has what plan. Is it feasible? Does it make sense? And the oil and gas companies that made all these pledges with reducing carbon emissions and net zero, there was a market reaction to this. If an oil and gas firm pledged to reduce carbon emissions way out in the future, 2050, the market didn't like it. There was, and if they pledged net zero and they didn't have concrete plans, there was a negative reaction. Their stock price got hit. So the lesson there is, if you're going to come out and say you're going to reduce carbon emissions or be net zero, you better have a credible plan. Otherwise, the market's going to discount your stock. And we saw that with BP. That is what happened, once Russia happened. And we talked about that back in December, where I said BP was going, oh, these oil and gas assets are a pretty good thing, and, because of the returns, and because of the energy security, and because of where we are, so all that plays in. And So I think that has to be considered in light of these scenarios. These scenarios are scenarios. They're still, okay, what do we think is happening? What is happening? And is there a disconnect between those stories?
So let's go back to the IRA, the Inflation Reduction Act. I mean, how do you view the legislation and the impact in comparison to what BP is saying, maybe even some other energy companies are saying?
Sure. Well, I think BP sees this as very significant. They see it as like one of the boldest climate low carbon packages in ever. And that's not wrong, frankly. I mean, we haven't actually, aside from some of the policies Europe has put forth, I don't think you've seen this kind of spend commitment of late, and I still think that they are, because they say, oh, there's going to be this growing use of hydrogen, low carbon hydrogen. They're focusing on hydrogen. I think in the United States, there's going to be there's going to be, those firms are trying to do hydrogen hubs. There's money for that, for sure. But there's also the CCS, carbon capture and storage and or sequestration, whatever you want to call it. And there's a lot of firms trying to skin that cat, including like Occidental has been coming out with a bunch of announcements. One is that, we're going to have this, we're going to invest in hydrogen hubs, and we're going to, or I can't remember if it was carbon or hydrogen. I don't know, whatever. I mean, no, it matters, but they were going to, delay their direct air capture facilities a bit. They said they're still doing it, but they're going to slow it down because, again, the market has said, oh, those are expensive, and now that we have this higher threshold for projects, we're not going to just throw money at an investment that we're not really sure about, so this is the tension. Is I think the market's starting to smarten up about these announcements. 3 years ago, we thought everything was great. Oh, direct air capture. Oh, a hub, and now it's like, okay, wait a minute. How much is that going to cost? Is it going to move the needle? Is this really a technology that's going to go? All these questions now. So I don't even know if that answered your question.
Oh no, well, but I think it's interesting. There's two things I think about. Obviously BP sees it as impactful, and then when you said that, I was like, are there other companies that also think it's impactful? And you mentioned, Occidental is one. I mean, surely there's got to be others who think this is going to be a big deal.
Yeah. Oh, well, I mean, Exxon has talked about it some, Chevron has talked about it some, and I've only really paid attention to what they've said. And not that I've not paid attention to others. But I think the big firms have come out and sort of, had to start staking a claim, basically. And Exxon is doing things, low carbon fuels and CCS. Absolutely. They have competencies in that. Chevron, we mentioned sustainable fuels, RNG, CNG, lower carbon gas, renewable gas, that sort of thing. They have competencies in that, so that's where they're focusing. And the IRA legislation offers subsidies. There's the 45Q tax credit, and that has to do with carbon, CCS. And of course, that's going to be utilized. And so, yeah, so you see different firms, picking what is doable within their competencies. And I think you'll keep seeing that. Now, on the renewable side, I know that, some of the EV monies, that's more relative to the car companies, and I don't really follow that per se. But I know that there's a lot of, talk and chatter about all that. Which direction is it going? And, but I'm back to, if you're going to count on subsidies for this as your business model, that's not a good long-term strategy, but anyway.
So to wrap it up, what should investors be thinking about all this? Not just what BP's thinking, but maybe what other energy companies are thinking and their approach with all of this stuff.
Well, I mean, I think you have to work it back to, you know, where's a return? Who's going to make a return? Who's paying dividends if that's what you value? If you want a richer stock, then you're looking at, in oil and gas, you're looking at the buyback route. I've said I prefer dividends, so I like PXD, Pioneer. I think Pioneer has a smart, sensible strategy. They are a top oil and gas producer. They focus on their competency. They are trying to produce the lowest carbon barrels they can. They have good returns. Oil prices are not going to go down. I mean, that is not the projection. I side with that. And I think that's the case for a while. I know we said even last fall, the setup was good for oil and gas. That, the trend is that oil prices stay higher. And there's a lot of reasons why that's the case. Many reasons that I jotted down notes, but I won't really go into it. But the fundamentals are such that the demand is there, the supply is growing moderately, and it's back to that. They're not going to put the pedal to the metal on US production like they did before. There's capital discipline and capital efficiency that are imperative now, because the market will hammer you if you're not doing that. And so I think that's what was happening with BP. It's not just those things, but it's that their strategy, given the reality of the Ukraine war and given the reality of fundamentals, weren't matching. And that's why you saw rewarded Exxon, Chevron, Pioneer. And we're in a bit of a period where there was a warmer winter. Natural gas prices are down, have been down, and that's just a weather related situation, and that's going to change because, as we know, gas demand just grows. It grows around the world. The US is a big beneficiary of this. Some of the natural gas stocks got some haircuts to their stock prices because of the warmer winter, but that's just cyclical, and that's going to change. I mean, as a longer term bet, the natural gas producers are also following the same type of discipline as oil and gas producers like Pioneer. They're not going to pump like they did before that made gas prices crash. They learned that lesson the hard way. So I think there's a lot of case, for US oil and gas E&P producers, and I go with, large cap, medium cap. I like Fang, I like Diamondback as well in the Permian. I have their stock. I have for a long time. My Oxy stock, I'm not as happy about because it kind of, there's been some challenges because of their debt, but they do have a lot of good assets. They have a lot of good assets they can work with. And I'm sure that's why Warren Buffett likes them. But so those are some of the names that I like. And I know there are some very good utility and renewables firms, and I don't have all those names off the top of my head. I was actually looking at some of them this morning because I think I want to dig in next time to some of the other, the IRA legislation and some of the stuff that we were talking about with the transition. I think that merits a little bit of a discussion, but this was so much just to set up what is the underlying trend, of, the commodity price shocks, which are going to have, filter through till 2030. So what's really interesting is the impact of Russia, how it's impacting the shock of it, even for the next 7 years, the projection. And that's true. You see it playing out in what US oil and gas is doing. Like I said, they're the beneficiaries of Russia's invasion, so
I mean, there's still all these implications that, I mean, they get bigger and bigger every day as long as this goes on too. And when
Yeah,
people, these transitions as well, outside of just the geopolitical stuff, it seems like the transition itself is it's a big deal.
well, and the transition got changed because of the war. You know, there are those that would say, I mean, there's really two camps again. Those that would say, oh, you know, we've got to produce energy locally. That's renewables, you know, and then there's others going, oh, you know, we've got to import now because we don't have Russia's gas, you know, but the grid matters, you know, what's on the grid, what the grid can handle, you know, what's needed for reliable energy source at the most cost effective method of production. And that's called that's affordability. You know,
Mm.
affordability, energy security, affordability, sustainability, you know, that's kind of the priority, right? I mean, security and affordability. Sustainability became a third rail. It's still important, and it's really important to advanced economies, and others would say so as well, and we all think so to some degree. But these two things matter because that's, you know, how people live, you know, pay their bills and stay warm, and that is not happening in Ukraine, you know, because of this. So that effect, those knock-on effects are real and significant, and it, you know, it is impacting everybody. It is impacting the global economy, you know, in negative ways, you know. So
There you have it. Another big conversation here. I appreciate the time.
yeah, thanks for having me, Michael. I enjoyed it, and I'm sure we'll talk again.